Ladies and gentlemen, I'm very pleased to welcome you at this webinar dedicated to the market monitoring report. It's the 12th edition of this market monitoring report edited by ACER. Here we're going to talk about the gas part of this report. A few information about the organization. You may see that you have a
Apologies, everyone. It appears that we have some technical issues. I'm apologizing on behalf of ACER. We're trying to resolve it right now. Bear with us.
Thank you very much. Well, that happens. Even though now we are quite well trained to these webinars, it happens that we have some technical issues. Sorry for this. So a few words. I was just introducing then this 12th MMR report dedicated to the gas market analysis, the European gas market analysis. Just to know that if you want to ask some questions, please follow the link to the Slido appliance that you will find on this slide. And the questions will be brought to the speakers. Today, we have two sessions. A first session, which is dedicated to the presentation of the main results of the MMR. So presenting the recent trends and market adjustments after the 2022 crisis. And then there will be a roundtable about the same topic and where we are, and we will welcome some speakers from ACER and EFET. Before getting to this, then a few words of introduction just to give you some food for thought for this meeting and to highlight a little bit the work which is carried out among the regulators nowadays, because you may know that there's been this electricity market reform launched by the Commission. We have the gas package under negotiation today. And so the regulators are collectively wondering about their contribution to these overall debates. So the first thing I would say is that we have lived a historical crisis. Probably it's the only one of that magnitude during the recent decades. Just to remind you, but you all know that, I guess, gas prices reached more than 300 euros per megawatt hour in summer 2022. We had electricity prices above 1,000 euro per megawatt hour sometimes in some national markets. So it seems that here we had a big crisis, also highlighting the interdependence between gas and electricity, which is probably something to be debated when looking forward to the future European energy system. But here, what happened with this market is that we had, following this war in Ukraine, this big tension on the gas market. And the factor is that with the current market organization, these highest prices spread over all the energy system, including the electricity market. So the MMR proposes a very smart analysis of what happened, and it will be presented later. And one of the important factors is that the market design, as it is designed, also helped importing more LNG to compensate for the decrease of Russian imports. At the same time, we could experience, even though the last winter was quite mild, a sharp decrease of demand by 14% in 2022. And in 2023, we already see a decline around 20% compared to the demand before the crisis. So without being back to the way the prices are formed on the market, I think it's important to look at the consequences of this crisis, which somewhere opened a kind of repoliticization of energy issues in gas sector as well as in the electricity sector. And we see that many regulations have been adopted in emergency to face the crisis. And now there is this reflection more looking at the long term. how did we reach this? Probably we have lived in a world of cheap energy for some years with the normal functioning of the EU market, and we may have forgotten a little bit the the crucial importance of security of supply, and we felt probably too secured about our supplies with the market working in normal circumstances. But now I would say the crisis seems to be a little bit behind us, and would be good to have a look forward, a look to the future. As you know well, the carbon neutrality is our horizon by 2015. And there is a question about the role of fossil fuels and precisely the role of gas. So maybe a question could be, say, well, in terms of energy transition is getting from a point to another, so it would be good to think a little bit about where we are today, and especially as far as gas is concerned, the role of gas in our energy mix. What we can say now is that, globally speaking, gas covers around 25% of our primary energy demand. And if we look at the final energy consumption, in 2022, an interesting figure is that gas consumption amounted to 4,500 terawatt hours, the final demand, versus 2,900 terawatt hours for electricity. So you see the difference, and filling that gap, switching from gas to decarbonized electric sources driven by electricity looks as a big challenge that we have in front of us. Another aspect is that when getting to the electrification of the system and the development of intermittent energy sources, we have this issue of supply continuity and long-term energy storage as getting more and more important. What we see now is that gas provides the bulk of flexibility, a large part of the flexibility to the electricity system. And if we just look back to 2022, 25% of gas consumption was dedicated to power generation. So now the question is probably, how can we best use the gas infrastructure and use gas as a kind of lever to facilitate the energy transition? And we all know that in network sectors, what is critical is covering peaks of demand. So this is the way we size the energy system. So a few words about the merit of gas and then how to think about the future. We know we have a lot of assets existing in the gas sector, and we have gas storages, and we have this capacity, the gas sector, to provide quite a lot of flexibility to the energy system nowadays. So as the question of long-term storage remains largely at both times a key element in managing the energy transition, and also as far as electricity storage, a challenge, let's have a look at how the gas could help then providing this flexibility. And in terms of regulation, the current situation opens a lot of questions. I would just give a few of them before finishing, giving the floor to my ACER colleagues. I would say, and it's part of our reflections nowadays, the first thing is how to anticipate the developments in terms of energy consumption. We have a lot of reflections about the energy mix. We have long-term scenarios driven largely by the decarbonization principles. But on the other side, we have consumers. And the big question is how to bridge these two elements about the ambitions in terms of energy mix and the energy needs. Then how to best adapt the value chains to have the proper combination of the different energy carriers. That's a critical issue. And here we see that the reflection on electrification has to look upstream to the sources of flexibility, but also downstream if one talks about hydrogen, about the future usages of electricity. Then I would say another very important point, and I will finish here. One of the key reflections that we have is, according to this deep uncertainty, how to anticipate investments, acknowledging the fact that in many areas we'll have a lot to do, especially in the electricity sector, but not only. So here are a few questions then to feed probably some of the discussions that we'll have during the roundtable. And thank you, and please, Joaquin and Vitya, floor is yours. Or Ricardo, sorry.
Yes, thanks, Benoit. Good morning, everyone. Thanks, Benoit, for setting the scene. And in fact, I'm going to guide you through this report, at least the second part of this report to start with, which focuses on the drivers that led to the unprecedented high prices in the gas market in the summer of 2022. And in fact, after me, my colleague Mitya will take care of describing a bit the most recent trends in the gas market up to now. I'm working at the agency together with my colleague Joaquin, acting as team leaders for the gas market and energy retail team, which was deeply involved in the preparation of this report. Let me, in fact, dive into this report by also telling you that part of the analysis which relate to trades were developed together with the European Securities and Markets Agency. And on that part, my colleagues will develop further. What have we done with this report? Clearly, several factors contributed to high prices in summer 2022. In order to facilitate the assessment, we decided to split those factors into 6 separate ones. Clearly, the split is somehow fictitious in the sense that all these factors relate to each other, and we can clearly see also triggering effects from the first one to the others. But this way, we were able to better assess the contribution of each of them. In fact, the chapters in this report are organized according to the drivers, and for each of the drivers, you will see a similar structure, allowing you to take stock of the importance of the driver, specifically during the summer of 2022, if there was an adaptive response from the market, and also the lesson learned about these drivers. Clearly, we identified as the primary driver the disruption of Russia's supplies via pipeline that triggered all the other ones. In a logical way, we tried to split the demand side and the supply side of the markets, where on the demand side, we focused on, strictly speaking, consumption of the different sectors, but also injections into the storage sites, which we consider separately. On the supply side, we focused on LNG markets and the congestions which occurred into the infrastructures, and therefore which caused issues in allowing the supply reaching the demand. Finally, as a 6th driver, we consider trading developments as clearly an enabler to reaching again the equilibrium of the market on the financial side, but not only on that. Here, there should be a slide on key findings. Here it is. Okay, let me go on the key findings first, and then I will give you a couple of examples on the more detailed analysis. But the key findings are, in fact, where we want to focus. What we found is that the disruption of the supplies from Russia was in fact the main driver that led prices up in summer 2022. The reason is that there had to be in the market also an intense competition to secure alternative gas sources, and this led prices very high. On the other hand, there was also dynamic into the demand part of the market, which did not help keeping prices low. But actually, since gas demand was relatively sustained, especially for storage injections and to fuel gas gas-fired power plant demand contributed itself to keep prices very high. A third finding, which we find very relevant, is about the role of LNG. It proved very essential to supply what was missing from previously Russian pipe sourced, but it proved so at a high cost, because in fact it relied on extra supplies often procured from spot cargoes, which were very costly because competing into the broader international market. A fourth finding that we want to highlight is the role of congestion. Congestion added cost, and this happened because the infrastructure was to some extent not ready to face these changes in flows. Russian gas was not coming anymore. Main flows were therefore concentrating in Northwest Europe, LNG terminals, and the infrastructure wasn't ready to cope with them. And that's why congestion also put an additional toll on the final prices. Finally, the trading environment also, we find that it played a role in adding constraints to the situation, because trading volumes remained quite high despite the surge in the margins due to the high prices. But the possibility to hedging futures product became more challenging. And then let me give you two examples on how we assessed, especially the drivers, which are the most important ones in our opinion. I will focus on the drop of Russian supplies. Here, what we plot is imports from Russian pipelines into Europe in year 2022. You can see with the different colors the specific different routes, and actually you also see on top of that the price on the TTF months ahead. Clearly, several events occurred in 2022 before summer, which already put some pressure on prices. But those pressures on prices could somehow be also taken back to lower levels, up to the extent that flows were still coming at a high level and respective to the past. While things started to change dramatically when flows on the Nord Stream 1 pipelines were affected, and we can see from the start of summer 2022, the yellow bars becoming smaller and smaller and prices going up. And in fact, that was the moment where it was no longer possible to cope with this supply scarcity. And the uncertainty which related to that led prices to very high levels. Clearly, there is also a role here in demand, which I will show you in the second slide here. 1 second. Here, yes. As we were saying before, all drivers are connected. There is a triggering event. This one of the situation between Russia and Ukraine, flows decreasing very much. But then what's the role of demand here? Because in fact, as also Benoit anticipated before me, overall demand in 2022 went down, but this happened in the last quarter of the year. During summer, demand, despite different trends in subsector of demands, overall demand was sustained because on the industrial and household side, consumption compared to the previous year went down. But this was more than compensated by the increase of consumption related to injections into storage sites in preparation for the winter, and actually also assisted heavily by public funds. And also demand was sustained by need of the power generation, because in the electricity sector, gas-fired power plant still constituted a more convenient way to cope with generation compared with other sources, despite gas prices were already very high. And therefore, with this analysis, we show that demand could not facilitate actually prices going down, at least in summer 2022. Afterwards, we see the trends of prices going down. And having said that, I will hand over to my colleague Mitja for a discussion on the most recent trends on the gas markets. Thank you.
Thank you, Riccardo. Let me just find my way with the slides. Okay, so Riccardo described our analysis of the price drivers in 22, what Benoit called historical prices. And now I want to take a couple of minutes to talk about how we see the gas markets now and what we believe the immediate outlook for the future is. And I will stay relatively high level to allow time for discussion. So from the start of 2023, we can say that the EU gas market has reached a new supply-demand equilibrium, which has been reflected in a significant drop of prices and volatility when compared with the peak of the crisis in the summer of 22. But compared with the pre-crisis period, what Benoit referred to as a normally functioning market, we find ourselves in a much tighter situation. And therefore, the supply-demand equilibrium can be described as more delicate, which is being reflected in the prices. And maybe to relate this to the previous part, how are those drivers, where are those price spike drivers now? So one of the crucial things, of the crucial changes we've seen is the coming into operation of new LNG import terminals. This has had a twofold effect. On one hand, the congestion at LNG terminals has been relieved, relying for more LNG supply to reach Europe. And on the other hand, also pipeline congestion has been alleviated. We are now in a situation where the demand driver is not as relevant because consumption is down on average for about 20%. So we can say that this new European gas market supply-demand balance and the relative stability of the market has been built on high levels of gas in storage, considerably lower gas consumption, and significantly higher imports of LNG supply. And what we have seen in terms of LNG supply is that it's been a crucial factor because to a large extent, it has filled the gap left by the drop in Russian gas pipeline flows. As you can see on the chart on the right, which I'm not showing, apologies. Here it is now. So the chart on the right shows how LNG as a share of total EU imports has climbed to over 40% of the total over the past year and a half. However, some Russian pipeline flows have been maintained, and given the tight equilibrium, this supply has been a relevant factor for the stabilization of the market. In relation, as the figure on the left shows, some gas regions remain relatively more exposed to any future loss of Russian supply. You can see in the chart the difference in estimated share of supply of Russian pipeline gas between 21 and 2023. So this means that these regions are more exposed to any future loss of Russian supply. And furthermore, through the interconnectedness of European gas hubs, such as a supply disruption would impact the whole of the European market. So moving on to prices and starting to conclude, today the European gas market appears to be well supplied, given the substantially reduced consumption and record high storage levels. However, as was possible to observe over the past 6 months, the markets are volatile, and developments that change the actual or expected gas supply outlook can have a significant impact on prices. So by what do I mean by this? There have been several events through the summer, such as the extension of maintenance on the Norwegian continental shelf in June and September that had a big impact on prices, the volatility caused by the Australian LNG labor dispute, and other examples. So this volatility and the persistence of historically high prices is, in our view, largely driven by a combination of a tight global LNG market and the fact that the European gas markets are now LNG dependent. So looking ahead, there are therefore several risks that could upset the equilibrium of the European gas market. For example, growth in Asian gas demand that would further tighten global LNG markets, stop of Russian flows transiting Ukraine that would necessitate either a further reduction in consumption or additional sourcing of LNG, unfavorable weather conditions, which in winter would mean a period of cold and still weather affecting respectively heating demand and wind power generation, or in summer heat and drought affecting cooling demand and hydro and nuclear power generation. Other risks that are perhaps top of mind at the moment would be a further escalation of the conflict in the Middle East with a more significant impact on LNG supply. However, on the other hand, if this or other disruptions do not materialize and gas consumption remains subdued, the possibility of gas prices correcting down to historical averages, at least for some periods of time, also cannot be fully ruled out. So with that, I think it's time to start our panel discussion, and I'm handing over to my colleague Joaquin, who will moderate.
Thank you very much, Mitya. Thank you very much, Benoit and Ricardo, for bringing us here to this second part of the webinar. And as you say, and we're moving now into a panel discussion about the way gas markets are adjusting to this referred new equilibrium and the implications, policy implications that this carries forward. So to do that, we have with us two distinguished speakers. I will invite also Pavel and Kasper to appear in camera so I can introduce both of them. Thank you very much. So we have with us Pavel Lund from IFET. Pavel works as a consultant on electricity and gas markets and has been cooperating with IFET for 8 years now. I guess he's a well-known person in the sector, and many of you will be familiar with him. Pavel currently is IFET's gas market manager and covering mainly the EU and Central Southeast European markets and topics. And then Kasper Seromski, also a well-known person in the sector. Thanks, Kasper, to join us. Kasper is the Deputy Director in the System Development Area of ENSOC, and he's responsible for the 10-year Network Development Plan and the security of supply-related tasks. And I can add that Kasper represents ENSOC in multi-stakeholder forums like the Gas Coordination Group or the Southeast European Gas Initiative. So before giving the Kasper and Pavel the floor, what I want to introduce, also to trigger a bit the discussion, is the forward-looking implications that we have detected in the report that we have structured in four areas. As the market readjusts, as Mitya, as Benoit, Ricardo were referring, we see that in the new equilibrium there are areas that need specific attention. On the one hand, clearly we have a much higher dependence on LNG supply. Mitya was showing this percentage of 40%. And this means that the expectation is that gas prices will become more exposed to global competition, and they will turn more volatile, with events in global markets such as Asian demand putting sporadic potential pressure on certain periods. Not only that, what we also believe from the regulatory community is that it's important to safeguard the competitiveness of the market, on a market that will be more heavily reliant on LNG, and particular attention is needed to monitoring the transparency and the access rights to the new terminals as the market readjusts to this LNG high reliance. There is another area that we call the finding an equilibrium between the emergency measures and well-functioning markets. In the height of the crisis, we all know that a number of emergency measures were necessary and were adopted. Just, for example, to enhance the injections into storages, as Ricardo was mentioning, but also the price shielding at retail level, the market correction mechanisms, the joint purchasing platform, the profits and taxes redistribution. So this created a moving paradigm in the market that needs to be made compatible with the well-functioning and traditional hub roles. So we policymakers need to reflect on that, and yeah, I think Pavel will have further considerations on the subject. The third area of attention for the report relates to the evolution of gas demand. Clearly, there is expectation of demand to decrease further than this 20%, could be 30 or more. Well, there are different scenarios, perhaps less, perhaps in different timeframes. But the expectation is that it will be decreasing, both to contribute to the decarbonization goals, but also to adjust to this tighter supply scenario and further alleviate price pressure from the demand side. But the reality is that gas now, Benoit was mentioning, covers, I think it's circa 40% of, let's say, circa 50% of the energy needs that electricity covers right now in Europe. But it does not only that, much a higher volume, but at a relatively half of the cost and also a fraction of the transport cost. So how we are going to manage to promote this transition, this electrification, this move also into decarbonized gases, into hydrogen, without damaging the competitiveness industrial sectors that also finding in gas a competitive supply, or not in 2022 that much, but historically has found that. So this is an area of challenge and implications. And finally, and to conclude, we also named the role of underground storages, how, on the one hand, engaging a sufficient market response to fill the storages ahead of winter without excessive interventions, so promoting the role of the market, but also finding the right equilibrium, the right trade-offs between a storage serving security of supply purposes, securing supply ahead of winter, but also promoting a role of the flexibility in the market in shorter timeframes. So this would be for the introduction, but I will invite in Pavel and Kasperis to elaborate on those aspects. Let me also remind before that, if you have additional questions and further questions, please post them on the Slido, and then after Pavel's and Kasper's interventions, we will be opening this questions and answer session. So thanks a lot from my side. Pavel, the floor is yours.
Yes, thank you very much. Thank you for the invitation. I hope the slide changing will work now. I hope you can see my slides now. I see people nodding, so it should be fine. Yeah, so again, thank you for the invitation. I think that I would just like to start by saying that the Market Monitoring Report is one of our favorite annual publications, usually because it's very insightful. But this year's edition is particularly interesting, and we particularly appreciate that because it makes some of the conclusions that we've been long waiting for ever since the publications on the different emergency measures taken last year have been published over the course of this year. And I'm going to start off exactly by that. Here's a slide where I've hijacked one of the graphs from the Market Monitoring Report that Ricardo was going through in his presentation. And why exactly do I like it? Why do I think there's a few very useful learnings from that that I wanted to bring up? So it shows that the primary reason for the crisis, for the energy crisis, was the shortage of gas. It takes us through the reaction from the market. It goes on to issues with infrastructure congestion, and then the situation where the market rebalanced. So what am I saying? What does it really show? There's no mentioning here of market manipulation, market speculation. In fact, it shows that the market flexibility that we had brought us back to normal and helped us go through the crisis. So essentially, the markets have worked. And of course, I am only expecting that someone at the workshop today, as in many other forums, is going to raise as how can you say that the markets have worked, that the prices have gone so up? Now, unfortunately, we need to recognize that that price signal was necessary. With a shortage of gas, we needed a price signal that would attract more gas to Europe, and we had to pay extra for it. And at the same time, we needed a price signal to encourage companies that simply cannot afford it to simply scale down on their consumption because there was enough gas. The only alternative to that was administered curtailment of consumption. And now if you think how much time we actually needed to come up with a basic concept of how do we do coordinated curtailment of demand in Europe for a situation of a full supply cut, you will recognize that what kind of challenge it would be to actually do it administratively, day-to-day, reacting to the situation on the market. So the market has done it in a way for us. Of course, there have been consequences. There is work to do, but we need to recognize that it was simply necessary and a reaction that simply stems from the supply and demand factors that you can see on the graph here. So the other thing I would like to mention as a learning is that the emergency measures that have been taken can also be a source of disruption on their own. And one example could be the forced filling of storages. We know that in some countries that was done very bluntly in a way that was simply the market operator was instructed to fill storages. And it unfortunately backfired heavily. It created tremendous cost that will have regional consequences. At the same time, some countries have gone for the market measures and incentives that have worked. And in some cases, they have proved that they simply weren't even needed because there was market demand to make use of these storages. And we need to keep it in mind when we go forward and look at the new equilibrium. And the first thing I wanted to mention here is the fact that we have learned that cooperation and coordination are key actually for Europe to stay strong. I'm going to leave to Kacper to talk about it. I'm pretty sure he has very good examples of it from the past year. I've seen many of his reports on the subject. You know that the TSOs have done also a great job in this respect in terms of coordination. But I'm going to use this as a segue to how we view how the markets were performing, are performing, and probably will be performing going forward. So here is a snapshot of our annual hub study that we do for each year. The cutoff date is July for each year. So this one is showing the results from July 2022 to July 2023. This also shows a time that is 9 years after the stated deadline for completing the internal energy market for gas. This is something that shows us that we really shouldn't be impressed by the work on some of these markets. The progress has been low for many years in many countries. In many countries, you have situations where the liquidity is very low. This relates also to spot markets, but even for the forward market that either is barely existent or simply doesn't exist at all. There is no clearing in most countries, and if in some cases on the countries that we are analyzing here, there is no exchange to be cleared in the first place. But none of this really is of relevance to this workshop today. What is truly problematic is that on this slide we still have countries where market access and flow of gas is effectively restricted or simply even impossible. We have countries like Romania that with multiple interventions to the markets has basically killed a lot of progress made in terms of market development and trading again. We have Poland that with storage obligations effectively keeps the market foreclosed, the country of currently operates basically on one importing company. And we have countries like Bulgaria that over the analyze period has made several changes to the structure of its market, going from the cancellation of the gas release program through the introduction of exclusive contracts for the former incumbent, and now the most recent case of a tax on imports and transit. In this case, a country like Bulgaria, which has quite a pivotal role in the region for transiting gas also, is going back into a state of monopoly. Now, if we think how much effort we needed to actually adjust to the situation from last year when it comes to providing collateral and meaning margin calls relating to the high prices, now we need to think, is it really prudent to have only one company effectively, or very few companies effectively functioning on the market? Whereas effectively it can cause a situation where this is a very big threat to security of supply. We need to think that on all of these markets, there should be multiple players that could actually pick part of the risk on their back, and this way we would diversify. Now, going on to the new equilibrium that Hawking has just described very well. I would like to start off by saying this short disclaimer that we are not out of the woods yet as Europe. Currently, we are still in quite a tight situation. We don't know how much LNG is going to be left available for Europe. We don't know how the situation is going to develop on different supply routes. There is exposure, yes, indeed. The markets remain tight and will be volatile, and so will lead to the prices. And that is the bad news. But there's also good news. The good news is that the contemporary gas market has all the tools necessary to simply deal with price volatility. In fact, in many cases, for EFET members, this is the very reason for these companies' existence. We have these mechanisms, we know how to hedge, we know how to operate, optimize portfolios, etc. The big challenge in this respect is that we need to remain able to do that. And there are interventions such as the market correction mechanisms that can simply prevent that. There's the very existence of the mechanism signifies that there's a risk that there's going to be an issue with trading. It can discourage trading. It can affect liquidity. It can affect the way that you can actually build a hedge, especially in a situation when we go closer to the triggering point. Secondly, if it's triggered, even if it's unlikely today, and it seems unlikely today, we need to recognize that contracts based on EFET standard contract will be reopened as a consequence, because the TTF benchmark will not be treated as reliable anymore. This will have severe consequences, maybe also on the physical side. This has tremendous exposure, and we really insist that care is taken and consideration is taken before a decision is taken to simply extend it for another year, because it will have consequences and it may backfire. There are also different emergency measures that have been introduced that can have negative impact, and they need to be carefully assessed. And one of them is can be aggregate EU. We don't have full visibility of the outcomes of the aggregate EU, so what is referred to as joint purchasing mechanism. And we would like to see that before a decision is taken to make that mechanism prolonged or indeed permanent, because it can have negative consequences, and this needs to be reviewed before a decision is taken. Now, the second aspect I wanted to refer to is the fluctuations of gas demand. Well, again, this is something that the market is dealing with for years, and the past few years are very good examples of this. We have the emergence of COVID, where demand was very low, and we somehow managed through. And we had a situation last year of very high demand and very high prices, and somehow we have managed through as well. The thing is, we need to make sure that we, as companies, have the ability to adjust our portfolios to the situations and have the type of flexibility we need to manage through. And this refers, because I think there's a growing trend to think that long-term contracts are better for safeguarding security of supply. Now, in a way, you can argue that some of the disrupted gas supplies from last year were also contracted under long term, and that didn't help exactly. But the bigger point is companies have very different styles of managing their portfolios. They have very different needs when it comes to flexibility and managing through the process. And this is not simply something that can be standardized. We should leave it to the companies to decide to what extent they contract for the long term, to what extent they use the market flexibility they can see, for example, on the LNG market. And I'm going to leave it for your consideration now. The other aspect when it comes to managing through gas demand and fluctuations is the accessibility of flexibility, not only contractual flexibility that I just mentioned, but also infrastructural flexibility. On one hand, this refers to the availability and access to capacities. And we are very happy to see that yesterday a formal consultation has started on the amendments to the CAM network code that we have been long asking for. It will likely take a long time, but we are happy to see that the wheels are turning. We really hope and we will encourage the TSOs to consider early implementation of the additional options to help us manage through the situation like we had with internal congestion. You probably saw there was a separate report on that subject from ACER as well earlier this year. The other flexibility that the market needs is also the use of storages. There are very different types of storage facilities serving different purposes across Europe, but there is demand for using them. And we need to make sure that they remain available for commercial purposes as well. So before we actually enforce storage obligations and try to fill them up and simply keep them there just in case, we need to recognize we need these capacities to go through the winter in many different regions. It's quite central to go through the winter. And that demand should be tested first before we actually impose the storage obligations. I mentioned before that it can backfire to simply enforce the storage obligation and ensure that the storages are filled, but it may simply prove that it's not necessary. Please take care to first test the market demand before enforcing an obligation that can, like in Poland, be foreclosing to competition and affect the way the market works. So as a final remark to all of this, in the new equilibrium, we do need more cooperation, more integrated markets, and less intervention. And if there's an intervention needed, it has to be consulted thoroughly, because otherwise we end up in situations like the long-term use it or lose it measures introduced through emergency regulation that simply did not reflect how the market works and had to be derogated from in all member states. I'm going to stop here. Thank you very much.
Thanks a lot, Pavel. I think your intervention was appreciated and you are receiving and triggering questions. We will address them after Casper intervention. But Casper, I would like now to invite you, and then we move into the questions. Thanks.
Thanks a lot. Let me at the beginning, of course, thank you for the invitation and congratulate you. Very insightful to report. As I share, I would say, interest that was expressed by Pavel. Especially this edition is full of things that are really worth to take lessons from for the future. And of course, now it is easier to understand charts when they are talking about the past, but still future is ahead of us. Thanks to I would say context set by Pavel in terms of from the perspective of market players, I will try to add perspective of infrastructure itself. This is basically what we are taking care mostly in NSOC. And in many cases, we are checking if infrastructure allows for the market to play its role. In many cases, basically, now we are far better posed than it was at the beginning of the crisis. And this is what I would like to start from. We in NSOC do many different simulations and analysis. One of it based, of course, on the data provided by our TSOs, and well, based on that, we were running some sort of analysis that we named minimum annual supply dependence. And we were measuring that for different supply sources to Europe. And basically, in a short way explaining it, it meant to measure which part of the demand or of the supply that is satisfying demand of given country cannot be replaced if this one supply source would be disrupted. So in TUNDP 2020, when we were simulating following simulation years for more or less period that we are here today, we identified that Europe is as a minimum dependent from Russian supplies at the level of 25%. So using all other sources and all other imports infrastructure, it was impossible to satisfy quarter of European demand from other source than Russia. But that's average for Europe, and you can see on the map that he's here on my slide. Some countries were not, I would say, having this need at all, but some other countries, especially Central Europe, Central Eastern Europe, was much more dependent on Russian supplies. And here we only were talking about minimum dependence, so minimum that could be then replaced. On your slides that were presented a little bit before, we've seen the actual market share of Russian gas in Europe, and in many cases it was much more than 50% and sometimes close to 100% in some countries. One of the first things that we checked, and that was based on the international group of liquefied natural gas importers data, it was how much not used yet liquefaction capacity globally is available. And simply comparing the figures, we came to the conclusion that it is impossible to replace the share of the pipeline Russian gas that is coming to Europe with just LNG from the supply perspective. Here at this one moment, we're not thinking about the infrastructure, but that is on the following points here. But this part was not possible to cover by to basically cover by using unused liquefaction capacity that were available. So it would not only mean that it need to be used at 100%, but it would consequently mean that Europe need to attract LNG that are those volumes are going to other consumers globally. And that's what happened. That was probably taking a part of the high gas prices as well, not maybe directly deriving from what happened, but I would say as a consequence. But that was only supply perspective. And those data are from the moment when it happened. Today, we can see that, of course, liquefaction capacities globally increased, but not that dramatically fast as our LNG terminals were deployed in Europe, because this is something what we then confronted our infrastructure with. Even if more LNG would be available to Europe, then would Europe be able to digest it? Whether infrastructure would put a limit and then, of course, distort this price convergence, for example. And yeah, first conclusions were countries that are here green on the map, they're mainly green because they were having quite well access to LNG. But at the same time, there was a capacity limitation to send gas from west to east because, of course, European system was designed other way around when Russia was delivering most of the gas to Europe from east. That was basically that basically was indicating that some actions need to happen. So what happened, and when the war started, how Europe reacted, and I think from the reaction we can as well derive conclusions how those gas market adjustments to new equilibrium looks like and will look like in the future. So one of the things is that through cooperation, many things can be achieved. We've proven that, and ENTSOG as well is providing the possibility on a daily, I would say, optimization of the system for dispatches across the Europe, especially, of course, this is our emergency measure through our regional cooperation groups, and many things can be actually solved. Sometimes through cooperation and dialogue and exchanging news, some things were just basically doable, even if at the first shot everybody was colloquially saying, freaking out. Then some tools were still in the hand of TSOs. There were many projects that are about to finish, and those projects were commissioned. Now we gladly can say that they are improving security of supply in Europe and making as well availability of the gas to European citizens easier and more diversified. But one of the conclusions that we've seen is that Europe indeed need to look for more supply, and LNG is a very good, I would say, example of it, because we don't see only disruption of Russian gas, but we see decline of the production in Europe. So this year, Groningen field stopped its production, which is significant, I would say, missing volume that need to be somehow replaced. But Norwegian fields are as well not, I would say, increasing its production. It's more stabilized or even with a small decrease there. And then demand response. Demand response actions is something that we were talking a lot in different forums, but some things can be achieved by more efficient usage of gas, keeping lower temperature, etc. But we forget that some demand response happened already during COVID, and some part of it will look exactly the same, meaning that part of the demand, if not satisfied for a long time, will be destroyed. So this is another consequence of that, what can hide behind demand response. And then preparedness is at least we need to monitor if storages are not depleted when they should be injected, and if we are having good perspectives. Because before war started, before those prices peaked super high, the problem was that some storage operators were depleting storages during the time when actually there was a need to inject them. And then winter 2021-22 started with only 76% of the gas storages. So at least monitoring is still needed, but of course through infrastructure, if it allows, that's the role for the market. This is basically how situation evolved and how it is more or less right now. Now we have much more LNG terminals, we have much more connections through across Europe, and those additional volumes can come to Europe. Whether we are talking about LNG dependence, I would say LNG is still a global market. There are many producers across the Europe. That's a natural question is usually because we don't import as much Russian gas as before to Europe, but there is still Russian LNG coming to Europe. Based on the same group of the LNG importers, I think in 2022, they were talking about around 20 or 19 BCM of Russian LNG still delivered to Europe. I free advertise, I would say, encourage you to check the report. They're very insightful as well. So there is still Russian LNG coming to Europe, but then it could be replaced by any other LNG. So because we then now have much more infrastructure located as well in those parts of the Europe that were behind the bottlenecks. So with new LNG infrastructure, we were able to bypass those bottlenecks, and that's how it looked. And I think in the future we are now we still have a few probably things from the infrastructure perspective to address. Awareness is raised, and then I think if we can keep monitoring and give market doing its job, that's basically new equilibrium that we are observing. Thanks a lot from my side. I'm ready to answer questions if any.
Good morning as well on my side, or already good afternoon. I would be guiding you through the questions, and I would connect the questions to the speakers. My name is Cilla Bartol, and I am part of the ACER team. So we received a couple of LNG questions, and I will try to little bit block similar questions together. Starting with the first one. The first one would go to Joaquin and Casper, and then the question is, what do you think about future import channels of gas in Europe? How they would look like? And feel free to start as at will. Joaquin, maybe you can go first, and Casper second.
Yeah, we will try to go rapidly to cover more questions, but Casper was elaborating on that. I think we have mentioned there's going to be a a higher reliance on on LNG. There are some studies prospects that by the end of this decade, LNG could account for more than half of the supplies. This is also to be seen in the perspective of a reduced demand. So if demand shrinks, then the distribution of supply proportionally also changes. I think we also could think and foresee a rise in non-conventional gas production, the carbonized gases. It's true that hydrogen is a bit the unknown. There are projections that are now being revised downwards. It will depend a lot on the price competitiveness, but also biogas and biomethane could be more stable rise. The Russian supply is unknown. We are not going to cover that. What will be the role in the future? So far, the agreement is consideration is that it will be maintain if it's something decreasing. And then, so Pavel was referring about the contractual long-term, short-term. There will be also an equilibrium decided by the industry. This will be from my side. And Casper, you can please complement.
To be honest, I think I don't have anything to add to. I fully sign under your interpretation.
Thank you. Thanks a lot to the both of you. And then we can move on to the question which investigates the estimation of the share of Russian molecules delivered as LNG to the EU, and how did that change following the Ukrainian invasion. Mitya, I would like that you come in on this one, and maybe anyone else, if you want to complement Mitya's answer, I would allow you kind of to freely interject. So Mitya, the floor is yours.
Question was on Russian LNG.
The share of Russian molecules as delivered as LNG to the EU.
I think Casper already covered it a bit when he was presenting. So it's about 20 or 19 BCM last year. It looks like those volumes are stable so far. I think I mentioned in my presentation that given where the markets are now, for the short term, and I think any sort of disruption will have a market price impact. The difference between Russian pipeline LNG, between Russian pipeline and LNG supply is that the LNG is fungible. So given enough time, those arrangements, if they were sort of disrupted, the LNG should find itself more or less in the same quantities to some other markets that would be kind of willing to take them. But what that means on the commercial side, maybe Pavel wants to say those volumes are under long-term contract. So what these companies are doing with those volumes in terms of hedging, what they have downstream, that could be a big disruption for those companies and on the market maybe as well.
Maybe just quickly, I cannot speak on behalf of companies and how they actually address that, but I am sure that market has the tools to swap the cargoes in a way that this would work well, more or less seamlessly on the supply and demand side. The price thing is probably a different story, but I'm pretty sure that companies know how to manage around it. Just a disclaimer that when it comes to banning Russian gas imports, it's a very tricky issue, and we've been discussing this for a very long time. And we just need to know that care needs to be taken before any measures are introduced, but because it can backfire. We know the Bulgarian example. Maybe there was a just reason, just cause for them to try to tax Russian gas, but this is not going to work, and it's only going to improve probably only improve the position of the incumbent rather than harm the Russian side. Thanks.
Thank you very much. Would you stay for the next question, Pavel, in the sense that we have maybe that we can go a little bit deeper in the fully centralized gas purchases? The question we received refers, like whether this would solve the situation and whether this would help in ensuring supply with no internal competition. What is your view on this and how traders do see this?
Yes, I think that the idea came up very, very quickly when the crisis started. I think many politicians, people that were never really dealing with the gas market, didn't really appreciate how complex the situation is. And they thought that maybe we can just buy gas in bulk like we did for the vaccines for COVID, and this is going to resolve the situation. But the problem is much greater than that. There are, of course, constraints on the physical ability to import these capacities. And of course, there are very different stakes on where they should be delivered. There are very different demand profiles that need to be satisfied. And this is not easily coordinated. And of course, the further away you are from the delivery point, the more you would have to be paying for transport of that gas into your country, even assuming that it would be physically possible, because it simply might not be. I think that we need to recognize that even we haven't seen the results of aggregate EU of the way it's structured right now, although it's not a purchasing platform, it's more of a matching service. It aggregates the Europe into several silos that are really even still very difficult to manage around. If you try to do it for all of Europe, you end up in a point where you still probably need the market to resolve it internally to trade around that gas. It's not a solution to that problem, although probably it would be very nice if it could be that simple. Thanks.
Thank you. Thank you for explaining, the complexities of what's behind trading and also the regional aspects. Now, we could be diving in very quickly, and we are extremely close to the end, but I would try to still address one more question, which is relating to what we would expect in terms of production of green hydrogen to have a relevant impact in the European energy market. And to help reducing the tightening on gas supply. And then maybe I would also connect this question, how EU could investigate additional gas-based fuel like methanol and ammonia to increase energy security and decrease dependence on LNG. And the first question I would offer to Benoit, who was introducing the webinar, and the second to Ricardo. Thank you.
Yeah, thank you, Cilla. In a very few words, I would say that green hydrogen remains something which is really forward-looking. And actually, there are expectations that green hydrogen would replace gas in some sectors where CO2 emissions are difficult to abate. But in terms of gas market, the complementarity between the two of them, or competition between hydrogen and gas, remains quite marginal potentially. But then the question of when would we have a clear impact, impossible to say. We have expectations of 10 million tons, as you know, of production by 2030. We know at the same time that we need a lot of green power to feed these electrolyzers. So you see quite a lot of challenges ahead. So I'm sorry, I do not give clear views about or clear answers to that question, but it's really difficult to say.
Thank you, Benoit. And Ricardo, could you jump to the next one?
Yes, thanks, Cilla. Yes, in fact, well, basically, if we consider the elements put in the question about the risk, the role of LNG, how to potentially secure that we get what we need through other different fuels. So in a sense, this LNG now situation, as my colleagues described before, is something that we are going to live with for the next decades. Actually, going to be secure in a sense because global gasification capacity, liquefaction capacity are going to increase. So that may not pose big risks in a sense. But then if we connect to the use of alternative gas-based fuels, now the topic enters several layers of complication. applications. One is really about the efficiency of converting these fuels, which has to be also consistent with the use we want to make of these fuels. So if we keep in mind also the decarbonization objectives, we think that these alternative fuels conversions, which requires conversion, may not be the best options. Actually, especially if LNG is going to become more secure. Now, to give also a hint on what the EU, there was also what the EU is doing for that. Actually, we as ACER, we plan to monitor LNG markets in quite some detail in the coming months. We have started our work. We will most likely be able to publish a report at the end of Q3 or beginning of Q4 next year, focusing on LNG. And also, as my colleague said before, we are making a big effort on monitoring decarbonization efforts as well. So the role of biogas, biomethanes, hydrogen when the package will be closed, and therefore so there will be more clarity on what to monitor. That, in short, is my reply.
Thank you very much, Ricardo. And then that means that we would slowly move towards the conclusions. I would like, first of all, to thank you, the panel, for the insightful discussion, but also previously the presenters to introduce the market monitoring report and explain the setting, the new market scenario that we have. With that, I would conclude. And the conclusion goes in the direction as what we described in the beginning of the discussion. We had an intense price competition in 2022 that's practically was driven by the Russian pipeline gas supplies, which disappeared, dried out. And then that meant that the market was competing for the available gas sources in a shrinking gas market. What was happening at the same time that we wanted to secure the winter for 22-23, so the storage inventories were increasing, and also gas-fired power generation was increasing, which then contributed to the escalation of the prices. Congestion was tight because the flows were reversed in the European Union, and then both pipelines and LNG terminals in Northwest Europe were more congested. Then moving forward, the market found a new equilibrium that was relying very much on finding new LNG supplies, and also with a drastic reduction of gas demand. And that mainly connected to the industrial users. These developments were helped by market signals, which were very usefully driving the market in certain directions. But at the same time, the end result is a heightened reliance on LNG, and then the markets remain still tight, and we have important volatility still today. Security as supply is not at risk now, but of course it's dependent and it hinges on various components, which then also explains the tightness of the market. Then how we go forward, what we believe that it's very important to have well-functioning markets. Pavel made a very clear reference to it, but also our report highlights that. With an increased dependence on LNG, it is very important that markets optimally distribute the supply towards demand. Probably we have to remain very vigilant and efficient in terms of demand reduction methods, not necessarily destroying industry, but also using more efficiently what we have. We need to keep an eye on continuous market integration, because this integration would help us to optimize and share resources. That means that we would need to have a very good capacity market and good access to market supply. With that, hopefully we will kind of better prevent disruptions. And then we would move on to fend ourselves in the current situation. With that, I am getting to the end of the webinar. Apologies for running over with 2 minutes, and I wish you a very good continuation of the day. Goodbye. Thank you very much.